Hi everyone and welcome to the Automotive Logistics live stream. I'm Richard Logan and I'll be your host for the next hour or so, where we'll be delving into the dynamic world of finished vehicle logistics and exploring how trade changes can translate into network gains. Structural changes in the market and shifting regulations are combining with disruption and uncertainty to create the perfect storm in finished vehicle logistics sector. Europe is on the path of becoming a net importer of vehicles for the first time in decades, contending with fierce competition from Chinese OEMs entering the market and striving to meet ambitious sustainability targets. In North America, shifts in policy and consumer behavior are forcing manufacturers to rethink product portfolios, while tariffs and a new era of international trade are challenging the supply chain models that have been forged over the last 30 years. Having navigated major crises such as the critical part shortage, COVID, the ongoing Red Sea crisis, driver and transport shortages, the collapse of the Francis Scott Key Bridge in Baltimore last year, and other major disruptions and incidents, the FVL sector is no stranger to challenge and has proven its resiliency time and again, and must now turn disruption and trade into those network gains. Finished vehicle logistics leaders are being pushed to remodel the supply chain, adapt distribution, transport and inventory more frequently, and utilize technology to meet changing market requirements and ensure efficiencies. Clear case in point was at our Nashville event recently on digital strategies North America, where the likes of Subaru, Volkswagen, Mazda highlighted the importance of data and AI in creating these efficiencies and these important gains. Of course, whilst this brings challenges in plannings and operations, it also presents unique opportunities for car makers and the vehicle supply chain to re-engineer the network and to meet strategic goals, including reduced transport and lead times, lower emissions, and working capital. On today's show, we've got a packed program with some special guests and industry experts joining me to share some key insights and guidance on how to navigate these turbulent times. I'll shortly be joined by my colleague and the Automotive Logistics Managing Editor, Emily Uwemedimo, to talk through some of the major FVL stories and trends we're covering. We'll then hear how Volkswagen is transforming and optimizing its network with Peter Hernlein, before taking a deep dive into the global market outlook and the impact and implications of the ongoing trade and tariff uncertainty with leading industry analyst Sam Fiorani. So buckle up and get set for a fast-paced and informative next hour. Be sure to get involved by asking questions to us and my guests, which we'll aim to address throughout the show. So first up, I'd like to invite my colleague, Emily Uwemedimo, to join me on the virtual stage. Many of you will have read her articles and seen her on stage at some of our events. And while she's not doing that, Emily leads the content strategy and editorial production for Automotive Logistics and the broader automotive cluster across digital, print, and multimedia platforms. Emily, great to have you here.
Thanks, Rich. Thanks for the introduction. It's always nice to have an introduction like that. And it's great to be here back with the audience again on one of our live streams. So in this section, I just really want to pull out kind of two of our main themes that we're really seeing dominate our headlines at the moment. The first one really being, vessel capacity is tight in both Europe and North America, and congestion at key ports continues to really build up. The knock-on effects of those are really real and costly for the industry. They're holding vehicles for longer at ports, and storage yards is really kind of tying up working capital. It limits operational flexibility, and ultimately it does drive up total logistics costs. And then I would say on top of that, volume fluctuations continue to test the system's resilience. We're seeing periods of sudden surges, for example, in March with the tariff stockpiling and congestion in Europe due to increased market competition with China, followed by sharp slowdowns, whether that's because of, as I said, regulatory shocks or just seasonal changes or just kind of normal consumer demand swings. And then I'd say in response to these kind of long-standing pressures, we're really now seeing it move to expand and diversify port networks, particularly in the Mediterranean. As Rich kind of noted here and said in our agenda, we will be hearing more directly from one of our guests, from Peter Herlein of Volkswagen Group Logistics, where he'll be diving into their strategy around network optimization, including their new terminal at the Port of Venice in Italy. I'll let Peter kind of share some of those details more with you later. But I think what is important to emphasize here when I'm talking about themes and trends is, at a time of, increasingly cost pressures and capacity constraints, they are higher than ever. And these kind of network investments are becoming even more critical. And we're not just seeing these kind of network investments and port launches happening in an isolated incident. We're also seeing similar strategic expansions ripple across other areas in the Mediterranean. As of today, we just published an article on a new vehicle terminal in Ravenna in Italy, which also aims to improve network flexibility and regional throughput. But that said, while these new networks are vital long-term enablers of efficiency and resilience, they're not just instant solutions to immediate capacity constraints. Ports do take time to ramp up fully, whether that's in the workforce, infrastructure, or local transport links. They all need to come online before new capacity translates into smoother flows. And the reality of fluctuating volumes and unpredictable trade patterns at the moment means that congestion and holding costs and equipment shortages will likely remain immediate operational challenges for the industry. And we're actually starting to see some of those kind of knock-on effects of those challenges happening, specifically in the Port of Antwerp. We published yesterday that the port has reported that they are congested in its terminals, and it's a persistent issue. They said that the outlook for the second half of the year is definitely uncertain and will depend on potential trade agreements between the EU and US by August 1st. And that kind of brings me on to my second theme, really dominating headlines. It's still very much the elephant in the room, and something I'm sure all of you are still covering and looking at a lot is the tariffs. I mean, the current situation with the tariffs is definitely driving a mix of urgent short-term responses and more longer-term realignments, as we're seeing happening with the ports just now. In the short term, in March, we saw a surge in shipments ahead of the April deadline. But in the finished vehicle market, it's hard to continuously maintain that. You can't suddenly double production. So we'll likely see some more changes in distribution timelines going forward with the tariffs. For North America's internal logistics, a significant question when it comes to the tariffs is how cross-border vehicle movements will adjust. Mexico to US traffic for both finished vehicles and parts is expected to decline for non-USMCA compliant goods, but for compliant vehicles, we'll likely see that flow continue, but with just some added paperwork and additional costs. We might have expected to see vehicles rerouted through Canada or other markets if the tariff renders it uncompetitive in the US. But with the warnings from Trump's most recent letters on the tariffs and the threat of higher penalties for those trying to bypass tariffs, it's still less certain if that nearshoring option will be viable for the industry. But that said, the penalties for evading the tariffs could be high, but how they're still enforced is still very unclear. And then just quickly looking at Europe, if exports to the US become less viable, automakers may likely relocate their production either to serve other markets or curtail it. European ports might see, fewer car departures to North America, impacting shipping lines and port processors who handle those volumes. But those logistics resources might also pivot to other trade lanes, for example, more focused on intra-Europe or European Asia shipments. And parts logistics can also be affected. Higher tariffs may encourage more nearshoring within North America, but again, this could come with penalties. And I won't dive too much into that fully right now, but if you are interested in this topic even further, we will continue to cover this in our ongoing tariff series. But to really sum up to kind of where we are with the automotive finished vehicle industry, with those two dominating headlines, is, you know, the industry has been long and finely tuned for a just-in-time supply chain, which is kind of now being challenged to become a just-in-case supply chain. It's really building buffers and building alternative routes to weather those protectionist headwinds. Though what I would say is that the automotive sector has weathered supply chain shocks before, natural disasters, you know, the COVID-19 pandemic, and one article that our Chief Content Officer, Christopher Ludwig, actually commented on post-Nashville is they have weathered these shocks, and that the trade is just another test of this resilience. But as I mentioned, if we just go to the next slide, it's just to show you that we are still covering these updates continuously on our website, which we've just redesigned and aim to deliver you with sharper, faster, and smoother access to these insights when at the time you need it most. We'll also have our magazine and, of course, our events as well. So we'll be continuing to cover this, the challenges and opportunities in the FVL market with you on all of these platforms. And at this point, I would just like to hand back to Rich.
Thanks, Emily. A great summary there of some of the key topics and challenges that we're covering. Obviously, our readers, listeners, followers can stay tuned as this dynamic landscape continues to evolve, and wait with bated breath for the next publications and updates from yourself and the team. So thanks very much for that.
Thank you.
And of course, we will be deep diving a little bit more into tariffs later on in the show. As well as getting the updates from us, it's important as well, the opportunity to benchmark, connect with peers in person. No better place to do that at our Finished Vehicle Logistics North America event. So do mark your diaries for next year's event in April 2026, all the way in California. So yeah, we look forward to seeing you there as well. And if you're enjoying this and want to rewatch this show, of course you can. It'll be available on demand, so you can relive this, as well as some of our other live stream shows that have taken place this year, where we talked in defining trends of 2025 with Nissan, as well as talking digital transformation and AI integration with colleagues from Mazda, from CATL, and others. As well, upcoming, next up, we're going to have a focus on innovations and strategies in automotive packaging, before we'll have a review and analysis of the key trends and challenges, fun and games that we've had in 2025, as well as a look ahead to 2026. That's later in December. So again, please do mark your diaries, and we look forward to seeing you there. So coming up in this next section, we're going to be looking at how Volkswagen has been responding to changing markets, production and trade by optimizing and re-engineering its European network for a more agile, efficient and sustainable approach. So I'd like to do that. I'd like to welcome my next guest, who has more than 30 years experience in automotive logistics and supply chain roles, including 20 years with BMW and later at MAN, leading brand logistics and procurement. Since last year, he's been leading vehicle logistics for Volkswagen Group Logistics, with responsibilities including network planning, network steering, port and multimodal transport in Europe, global shipping and governance, as well as digitalization. I'm very pleased to welcome to the show Peter Hernlein.
Richard, thank you very much for the introduction. Good afternoon, good morning, good evening from wherever you're watching, everybody. Hi. So let's see what we have done in order to do some setup on our European port network. Please click to the next slide. Abraham Lincoln once said, the best way to predict the future is to create it. So let's have a look what we have created to deal with a rather unpredictable future these days. On the next slide, I would like to give you a rough idea what group logistics in Volkswagen is all about. To put it in a nutshell, we consider ourselves as a logistics service provider for the whole Volkswagen Group, basically for all of our 12 different passenger car brands, And we also deal a bit with the heavy commercial vehicles and other branches of our group business. But in total, we are connecting more than 100 production sites with logistics solutions. And that is basically an inbound network, a packaging network, but last but not least, obviously also a finished vehicle network. And we try to bring solutions to the group, focusing on the group optimum and really offering a service which ensures that logistics is done in a timely and in a cost-efficient manner. On the next page, please. Let's have a look at some of the key figures of our vehicle logistics network with some facts and figures from last year. So basically what my team is responsible for is doing all the finished vehicle movements within Europe, everything that goes from Europe to the rest of the world, or everything that comes in from the rest of the world into Europe and is distributed within Europe. What we do not do is we do not touch vehicles being produced in China for the Chinese market. We do not touch vehicles being produced in the US or in South America for the US and the South American market, respectively. But by doing so, we are dealing with more than 1,000 partners, logistics service providers, shipping lines, trucking companies, railway companies. We are connecting our production sites to more than 150 sales markets. And in total, we have moved 4.8 million cars last year, 2.7 of them via sea freight with more than 1,500 sailings. But also we have a quite significant amount of either rail wagon movements or truckloads being moved every year. And we offer that service for all of our passenger car brands, as well as for our heavy commercial vehicles from MAN and Scania, which we are mainly taking care from the sea freight side. And last but not least, we are also the service provider for all the used car business within the Volkswagen Group, which in the meantime also amounts to more than 800,000 cars a year. On the next slide, please. You can see an overview how we brought vehicles out of Europe. And historically grown, we have seen a concentration to northern ports, whether it's Zeebrugge, whether it's our own port in Emden, whether it's Bremerhaven. So mainly whatever was produced in Europe, especially in Central Europe, was firstly brought to a Northern European port before it was then shipped to the world. And obviously that strong push, having 74% of our cars moved up north, led to inefficient transport routes, also high costs in terms of long distances and long lead times that needed to be covered in order to get up to the north. A quite inflexible network with limitations and congestions that Emily was referring to. And also in general, we saw a shortage of capacities. So obviously there was a need to improve that situation. If we look to the next slide, so coming from a traditional move up north and then either traveling around Europe through the Mediterranean and then through the Red Sea, or in these days around Africa, we just thought, okay, what if we take the cars from our plants that are based either in the south of Germany or in the Czech Republic, Slovakia and Hungary, and bring them rather than up north to a port in the Mediterranean. And then from there, connecting Asian markets and Turkey, ideally we would go straight through the Mediterranean or through the Red Sea, or even if we have in these days go around Africa, this would still cut our lead times. So basically that thought was arising, and in the port of Venice we found an alternative where we could realize that idea. And on the next slide we could really see what that led to. Basically, it's a project where you can use all of the buzzwords of these days in one project. We were able to cut lead times. We were able to reduce costs. We were able to reduce CO2 emissions. But at the same time, we have an increased flexibility and an increased resilience, because we still have the northern ports as a backup solution. We have split the volumes with the concentration Asian volumes and volumes for Turkey will go out in the future via Venice, and the rest of the world will be still connected via the northern ports. And we have a chance to switch back and forth if capacity constraints or if volume needs adaptations. So in a nutshell, it's a multiple win situations, which also offered a quite substantial contribution to save CO2 emissions here. Let's have a closer look on the next slide, how that project was going. Basically, from the first meeting or from the first idea, it took us 2 years to really award the business. You can see from the picture up on the right-hand side where the port is located, you can see obviously the famous city of Venice. And with the red mark, you can see the Port Marghera area where the port location is located. And on the bottom picture, you have an aerial view how that site looks like. And of course, it's an old industrial port area, an industrial area which was mainly used by the petrochemical industry in the past, but it has kind of been abandoned and not been really in commercial use over the last couple of years. And there was a nice opportunity to create a port for finished vehicle movements. Of course, we had also to align and harmonize all of our rail and road and sea freight contracts to that. We also had to get a concept in place and to tender the port operations. But having done that and having discussed the project further with the port authorities, with an investor, with a potential port operator, we were able in December last year to really award that business and to really get into action and to really prepare ourselves to be ready for day X. On the next slide, we have some key facts and figures around that port area. So basically we have 10,000 parking spaces exclusively for our Volkswagen vehicles that we can basically handle there. It's a designated berth area where we only handle ships that work on our behalf. And the port area is connected with 3 railway tracks to bring in the cars, as well as a connection to the highway network in Italy. And the next highway connection is only 7 kilometers away. So that gives us, number one, the exclusivity, but number two, also a good connection to the infrastructure. And at the moment, everything is going on and is in preparation to be ready for the first shipments in October this year. For sure, we would not have been able to do that on our own or all by ourselves. And obviously also the Port Authority had to help us a lot. So they also did investments in the infrastructure, mainly the lighting to the gateway passage to the port area itself. And we have now a 24/7 accessibility. There is also a new railway bridge in place for faster shunting of the wagons. And also for sure, we had to do some research and simulations to make sure that the port itself is really able to handle the big passenger carrier vessels. We wanted to be sure that we can handle vessels up to 230 meters of running length, so that Venice is not only capable of handling the picturesque gondolas, but also pure passenger vehicle carriers, our ro-ro vessels. And the coordination and the cooperation with the Port Authority and with the investor was very nice. It was very proactive, and all that coming together was a big enabler to really get everything on track and have everything in place for October this year for the first shipments. Let's have a look at the project status on the next page. Basically, since the beginning of this year, we have been in a very intense project implementation and realization phase. Especially the berth area is a critical path because that needs to be enabled and enlarged to be able to handle the ro-ro vessels. But basically, the work on the railway lines is completed. We have also 50% of the parking spaces finalized, and the rest will come in the second half of this year. And also the confirmation is there that the berth area will be ready by September. So from today's point of view, everything is very much on track that we can have the first shipments starting from October this year to markets in Asia and to Turkey from Venice. And for sure, on the next slide, you can see that we will not flick the switch all at once. We have prepared a smooth ramp-up curve, but Venice will be a strategic anchor in our port network from October on. And we are starting slowly towards the end of this year, connecting China, South Korea, and Turkey. But then obviously we are ramping up, and in the near future, we will see a volume between 180,000 up to 200,000 vehicles going through Venice per year. And to give you also a couple of insights from the operational infrastructure, we are basically looking at handling 20 trains a week, also 40 trucks a week, and we want to deal with 8 vessels per month. So basically 2 big vessels will be handled every week there in order to manage these 180 to 200,000 cars in the future. So from our side, everything is ready. We are really looking forward. And as I said, we have found a solution, found a new strategic port in our network to enhance our network. And that's an enabler to cut costs, to cut lead times, but also to help on the sustainability side and also to help on the cost efficiency side. So in total, a quite nice project with a multiple win situation. Thank you very much for your attention, and I'm happy to answer any questions if you might have any.
Great, thank you so much, Peter. Fascinating insights, a real exciting project showcasing the adaptation of your network, creating those opportunities, not least in a time of tumultuous challenge being faced by the world over. Call out to our audience. If you do have questions, please do participate, do get involved. We'll get them to Peter. Perhaps a few of my own to kick things off, focusing first on Port of Venice. You mentioned there about the potential for rail transportation network there. With these new capabilities, how will this alter the network's balance of overall balance of transport modes? And how does this fit in with Volkswagen Group's overall drive for reduced emissions and the drive for sustainable transport network?
Let me put it that way. We have a very high and significant share of rail work at the moment already, which is, from my point of view, the biggest enabler to cut emissions on the land transport side. And we are in a situation with all these infrastructural challenges, with all the construction side in the European railway network, that we have to fight every day to keep where we are, because there are so many congestions and limitations these days that it's rather a challenge to stay where you are and not fall backward. So at the moment and in the starting place, it's not really a significant increase in our rail share, but it's also a big enabler that we can keep the rail share where it is. But then for sure, if we go into higher volumes and if we move more volumes towards the Port of Venice, then for sure we also have the chance to engage more trains there. So in the long run, it will also contribute to a higher rail share. But for the moment, it will not change things drastically, but it's a big enabler to maintain a quite positive status where we are right now.
Yeah, excellent. And just sticking with the port for the time being, have you already or will you plan to integrate some value-added services and capabilities, be it kind of delivery, inspections, repairs, modifications, etc. at the new terminal?
There is definitely a plan to do so. And also the partner we have down there is capable of doing these services and offering these services. As in the first step, we are mainly using the Port of Venice for exporting cars. It will not be really necessary in the first step. But then for sure also there are ideas because we are also seeing some imported volumes from our own production sites in China that might come through that channel in the future. So then for sure this becomes a quite important and great option. Also, we are in discussion with other partners to integrate volumes maybe from other OEMs through that port, and then for sure this is also a setup or an option which we do not want to miss. So definitely the discussions are on. It will not be needed in the first place.
Yeah, excellent. And fantastic to understand and see how you're kind of future-proofing for upcoming eventualities and possibilities. So just keeping on kind of network optimization, a few more kind of questions from my side. As a major OEM, where do you see the most need and opportunity for network engineering, for optimization in the European network? Do you have some examples there?
Well, we are constantly reviewing the network, and you can never really be at the standstill, because once you have a solution and once you have a setup that works for a while and at the moment rather for a short period of time, and then you see changes. You have different allocations from models to production sites. You see different market behaviors, some markets going stronger than expected, some markets going a bit weaker than expected. Also, the tariffs add a big question mark. How big will the export volumes towards the North American region will be? So we are constantly reviewing the network and constantly optimizing it. For sure, a big change will be, and that has been announced through the press already, from 2027 onwards, we will produce the Volkswagen Golf in our production site in Mexico. So there will be definitely then less need to bring vehicles towards the US, but rather to have a quite substantial volume coming from North America into Europe. Also, there are new models on the horizon, like the smaller BEV cars, the ID2 All or the ID Everyone, as we call them in the projects right now. They will be produced at European sites, and that will also add different volumes to the network, or different needs to adjust our volumes. So basically, we have to keep the eyes open at all times and review it constantly. And that also leads to contractual setups, which we consider with our partners to see, okay, we have to build in another portion of flexibility, or when we know that there are major changes coming up from production volume side, we rather have shorter contracts, and then once these decisions are done or the operation is there, we then have longer periods again. So that additional amount of flexibility we are building in consciously in our setup these days.
Yeah, excellent, thank you. We had a couple of questions from our audience come through off the back of the presentation, Peter. So I'll put you on the spot a little bit. Someone's interested in understanding who some of the stakeholders are within the Venice. So are you at liberty to share details of the operating company you're working with?
Yes, since we have announced that already, I can. It will be Tenkara as our partner operating the terminal in Venice.
Okay, excellent, thank you. And then another question regarding the introduction of a southern port into kind of your network. Sort of how is the overall network, including those existing partners, how are they accepting and understanding the news and the shift in certain volumes? Is that sort of easing some congestion in certain places, easing their burden? Yeah, some insight there.
Yeah, of course, we have communicated that in a proper manner. We are also within the framework of the contracts we have there, so we're not just pulling out of an existing operation, and that is played quite openly. For sure, it will help to ease some of the congestions and limitations in the services that we have seen in the past. So overall, it will lead to an optimized setup, and it's not that we are pulling out of some of the existing ports completely. there will be just adjustments of volumes, or maybe then also allocation of volumes to different markets whenever Chinese, Korean cars and cars designated for Turkey will be handled through Venice. And as I said, we are mainly targeting production volumes coming out of central and southern German plants, going through Venice. So everything which is produced in the more northern German plants will still go through the northern ports, given the proximity. We have a special situation with our own port in Emden for sure, which is, you cannot really say where does the Volkswagen plant in Emden stop and where does the port in Emden begin, because it's a seamless operation. But Emden is not affected by that at all, because Emden is mainly dealing with our exports to the US and all of our imported vehicles. So the cars we have in mind going through China and going to Turkey, they have not gone through Emden in any case these days.
Yeah, excellent. Thank you. Thank you for that insight there, Peter. So we've come to the end of this section, but we will have a few more questions, and if you do have more questions for Peter, please do kind of continue to get them in. We'll make sure that he gets them. For now, I'm going to say thank you very much, Peter, for the presentation and your insights. We'll see you shortly after my next guest. But yeah, thanks very much. So moving on to the next section, I want to bring on my next guest, where, as my colleague Emily alluded to and mentioned, tariffs and trade uncertainty is clearly a hot topic, something that's really driving and steering the sector right now. Tariffs and trade, certainly uncertainty, haven't quite ground assembly lines to a halt, as some have suggested, but as Emily rightly pointed out, they are having a profound impact on costs and operations in the short term. With my next guest, we're going to take a look into the market outlook and understand what sort of some of the short term, but also the longer term implications are for vehicle manufacturers, the vehicle supply chain in North America and Europe. So with that, I'd like to welcome my next guest onto the virtual stage. He's a lifelong car enthusiast, having received his first car at just 3 years old. Since then, he's sold cars, worked on cars, written about cars, and for 30 years has been providing intel, insights, and analysis for the automotive industry, including over a decade with Auto Forecast Solutions. Today, he's one of the leading voices in global vehicle forecasting and market analysis in the US. So I'd like to welcome to the stage Sam Fiorani. Sam, great to have you here.
Very much. As an introduction to AFS, each member of the core team of AFS has been professionally forecasting global automotive industry for over 25 years. And I've been studying this industry, like I said, since I was a kid. I love talking about what makes it tick. So let me get right into the forecast here. To understand the European and North American markets, we need to see their place in the world. After vehicle production took a hit during the COVID shutdown, it's been struggling to get back on its feet. We've had semiconductor issues leading to today's trade issues, and all of this putting a damper on demand and supply. China had been the engine of growth for years, raising global output of light vehicles to nearly 96 million units in 2017 before hitting a series of rough patches. After bottoming out in 2020 at just 74.6 million units, the industry is on a slow and steady growth pattern, which will take it above its previous record in 2028. Before China's market reset, the world was quickly heading towards 100 million units, but that target has been pushed back till 2032. In North America, the peak was back in 2016. This mature market had 14 vehicle manufacturers producing nearly 17.8 million vehicles, but the market has changed since then. The first change was legislative, when the U.S. altered the way it measures fuel economy and emissions. The original fuel economy regulations, called Corporate Average Fuel Economy, or CAFE, measured a company's entire fleet. This allowed small cars to balance out big cars in the market that prefers large models. When the system was recalibrated in the 2010s, vehicles were measured based on footprint, not fleet. Each size of the vehicle needed to be efficient. The small loss leaders like the Chevrolet Cruze and the Ford Focus no longer balanced out profit centers like the Chevrolet Corvette and the Ford Mustang, and those small cars were removed from the market. It also removed most of the inexpensive vehicles, pushing entry-level buyers into the used market. The other change was the shift to electric vehicles. Oops, give me 1 second. Sorry about that. One too far ahead. With 14 manufacturers in 2016, only Tesla was dedicated to building EVs. In the next decade, we've added Lucid and Rivian. We're adding Scout and Slate, but we're not adding much volume. This means the higher cost of gas vehicles alongside the lower volume EVs will spread more than 1 million fewer vehicles in the market across twice as many manufacturers by 2032. For many manufacturers, the transition to electric vehicles was expected to move much quicker than it's doing in the real world. While we had always been very conservative in the speed at which this shift to EVs would take place, the market is growing even slower. Automakers put all their eggs in one basket and planned for EVs to replace ICE-powered vehicles going forward. Many brands announced dates when they planned to offer nothing but electric vehicles, and we knew this was premature. By the time they realized this, no replacements for their ICE products were on the drawing boards, and introducing even more EVs would add to a saturated market. Getting ICE models back in the plan means we'll see a spike in new products by the end of the decade. Changing emissions regulations in the US is also going to prolong the EV transition, as buyers will no longer be incentivized to get an EV and manufacturers no longer need them. We currently have a place where manufacturers are taking a step back. The idea was, in order to build electric vehicles profitably, they would require dedicated platforms and dedicated factories. Stellantis' Stella platforms were introduced as fully electric, but shortly after their announcement, the platforms evolved into where they could be fully electric, fully ICE, or somewhere in between. Other automakers quickly followed, and more of these evolutionary platforms will emerge. New factories once planned to make only BEVs are now able to apply multiple powertrains to vehicles on the same assembly line. Many forecasts showed electric vehicles taking over the United States by the end of this decade, while we were not quite as optimistic. Even our most conservative model was not conservative enough, and we've revised that outlook a number of times. Currently, we're looking at 15% of the US market being fully electric by 2030. In the US, buyers can be generically grouped into 3 categories. About 10% of the market are early adopters and looked at electric vehicles as the next big thing, and this market is about tapped out. The next 80% of the market are everyday drivers who need to be convinced that an EV is right for them, and they will take a long time to make this shift, probably into the 2040s. The last group are motorheads that will not give up their keys to fossil fuel vehicles until the last possible moment. Expect them to be still driving an ICE vehicle in 2050. This shift has been further tempered by government incentives that go away at the end of September and controversies surrounding Elon Musk and Tesla. Just to demonstrate how far off the industry was in anticipating the shift to electric vehicles, here's a rundown of GM's plans and a reality of the EV rollout. This slide shows from 2023, but it gives you an example of where the market has changed. Relative successes of the Chevrolet Bolt and Cadillac Lyriq are offset by extremely slow sellers like the Bright Drop vans and the GMC Hummer. The Bolt was priced low because GM lost its Obama-era federal incentives when sales crested 200,000 units. But when Biden-era incentives kicked in, the price dropped again, making the Bolt one of the most affordable EVs on the market. And the volumes show for that. On the other hand, large EVs like the Hummer and the Silverado EV pickup lose range dramatically when they're towing or hauling, making them far less practical for their design purposes. Additionally, these trucks came into the market around $100,000 each, targeting high-end buyers, but there just weren't enough of them to float the expected supply of these EVs. I'll make all these slides available at the end of the presentation if you'd like to see it. And the question on everyone's mind is, how are the tariffs going to affect the industry? While that's an excellent question, we need more certainty about how the situation will play out before we have solid conclusions. The North American market has been built up around the free trade zone currently known as USMCA. Manufacturers and suppliers count on the ability for vehicles and parts to move across the borders at minimal cost. This isn't an industry that can move quickly. Sudden tariffs and distributing the free trade agreement adds cost, complexity, and uncertainty. Next year, when the USMCA comes up for renegotiation, there are likely to be changes and an increased focus on keeping more vehicles destined for the US market sourced locally. Reducing the demand for products shipped from Canada or Mexico to the US will upset the balance sheet and could result in the closure of some plants. Additionally, vehicles shipped in from abroad could be priced out of the market, and those are not typically sold in volumes big enough to warrant local production. This is bound to increase costs, reduce choice, and likely stifle sales growth in the US. Which takes us to Europe. Like North America, Europe has had a production peak about a decade ago. At that time, there was an eastward shift with production in Western Europe moving from over 83% of all output in 2002 down to 65% 10 years later. The shift has continued, but it looks to be leveling off at around a 3-to-2 ratio. A large war in the region and sanctions against Russia haven't helped. If stability returns between Russia and its neighbors, we could see growth again, but that's not likely to happen in the current environment. Unlike in North America, the shift to electrified vehicles is moving much better. In addition to hybrids that are pushing pure ICE vehicles aside in most regions, the growth of EVs is strong, powered mostly by regulation, but also by better consumer acceptance. These charts are looking at the xEV market, meaning any vehicle that has an electric motor. This includes standard hybrids, plug-in hybrids, battery electrics, and extended range electric vehicles. Plug-in hybrids make a nice transition for consumers as they learn to plug in their vehicle, but not enough owners are actually doing it. This is being reflected in the higher emissions ratings under Euro 6 standards. As you can see, the relative number of PHEVs remains low, while the share of battery electrics among electrified vehicles surges. Instead of retrenching and putting up barriers, Europe is preparing for battle. Chinese automakers are on their way and will take some of the market share away from legacy companies. We've seen new models taking on all imports at all price points. Companies like Renault and Stellantis are turning the tables by learning from their Japanese partners on how to make more affordable and more profitable EVs. The competition isn't going away, and to survive, legacy automakers need to be ready for this new generation of vehicles and consumers. Production in Eastern Europe tends to focus on lower cost models, and because of this lags Western Europe in the shift to xEVs. Pure ICE models will make the majority of the production in the region through the rest of the decade. Battery electrics will only account for about a third of all electrified models by 2031, about half the rate of Western Europe. Just to see how each of these regions stack up, here's a global xEV outlook. While China has battery electric volume, Western Europe passes it in production share. China has positioned itself to become the global leader, and slowing demand at home will push China to increase its exports. Some of these manufacturers will need to find homes in Europe for local production, just to keep regulations at a distance and keep the market open. We're already seeing investment by BYD and Chery in Europe and expect others to follow right behind. Chinese manufacturers will not let off the pressure. The choices include increasing their costs, competing on their level, or allowing them to increase their market share. While they're operating at a price advantage, the playing field needs to be leveled before the competition continues. Europe has an advantage that they haven't entirely given up on entry-level models, but Chinese automakers are willing to undercut them even with those vehicles. We've been watching the impact of the recent tariffs have had on North American production. Automakers are keeping a close eye on where negotiations are moving, and holding back announcements until the politically correct time to reveal them. Stellantis, for example, has been holding back the production of its next-generation Jeep Compass, partially because they need to prepare the gas-powered versions ahead of the EV launch, but partially because the production is scheduled to begin in Canada. Jeep's new Cherokee will enter production later this year, but it has quietly announced a few weeks ago to stay under the radar because, again, production in this one is happening in Mexico. Moving items in its favor, General Motors made a splashy announcement of a $4 billion investment in U.S. factories. Included in the plan is the next-generation Chevrolet Blazer to supplement Blazer EV, the next-generation Cadillac XT5 to offer its buyers a choice in a largely EV showroom, and U.S. production of the Chevrolet Equinox, which was entirely produced in Mexico until now. Items caught in the crosshair include BMW and Mercedes production in the U.S., as well as Audi production in Mexico. These plants were expected to supply not only the U.S., but a sizable number of export markets. BMW and Mercedes export more utility vehicles from their U.S. plants than they sell in the U.S. Audi's plant in Mexico currently offers the Q5, but had planned on being the sole global source of other models until the free trade rules with Mexico were interrupted. With the administration targeting 90 deals in 90 days, there was a line drawn in the sand, but that deadline has passed with only 2 agreements worked out so far. Finding a way to free up trade with the EU, as well as South Korea, Japan, and Mexico will be difficult. Until that happens, the whole industry is holding back investments and product plans. Electrification is coming, but modern evolutionary platforms will be necessary in the current transitional phase. New battery technology and charging infrastructure will convert more and more buyers, but this will take time. We've spent almost a century and a half developing the internal combustion engine vehicle and only about 20 years on the modern electric vehicle. It's difficult to plan with the current tariffs and trade issues. It's likely that the plan was to have the world fold to the U.S. tariffs, but it's not going to be that simple. When the tariff issue is solved, we won't see the U.S. as an export hub and will likely see increased costs for U.S. buyers and fewer choices. At what point would the market be considered stable? In addition to the tariffs, the industry is in the middle of product revolutions. The shift to electrification is just part of it because the longer-term evolution includes monetization of data from these vehicles as a significant profit center. And that's before we get into autonomy and beyond. We hope to see trade stability in the coming year. We do expect changes more than stability across the industry for a long time to come. And that's our look at the outlook. Thank you so much.
Thank you, Sam. Fascinating whistle-stop tour there.
Sorry, it was
really
so quick.
Diving, some excellent insights. So appreciate you giving us that and sharing the slides as well with our audience, making them available as well. And of course, you can watch this on demand to re-go over that. I suppose perhaps you semi-answered this already. The billion or multi-billion-dollar question: do you expect stabilization in the trading landscape anytime soon? It's probably something that all our audience want to know.
It all depends on how you define stable. The current trade issues with the U.S. should shake themselves out in the next year. All the markets can't deal with the instability that has been caused by the rising tariffs and the destabilization of free trade zones. So finding some sort of answer to this has to come. We're likely to see some movement in the next few months on a smaller basis, but we're going to need longer-term answers like a new USMCA agreement next year. This has to stabilize everything, and this industry just doesn't deal well with this much confusion and additional cost. It just can't move that quickly, and it takes years to come up with answers to problems that were suddenly thrown in the industry's lap.
Yeah, of course. Thank you. And at this point, I also want to welcome Peter back if he's still there with us, of course. But while we do that, Sam, one more question for you. Car makers in the US have been taking different approaches and strategies when it comes to vehicle pricing these past few months. Some passing on increased costs, others maintaining pre-tariff rates, perhaps whilst inventories lasted. And in a strategy to maintain market share. How do you see this playing out if the current instability maintains and is ongoing?
The current strategy was to keep the prices stable so that consumers would keep coming back to the dealerships. The announcements that all these tariffs came online made consumers confused about the pricing, and that the pricing was suddenly going to go up. So by keeping the prices announced to be steady, kept consumers coming into the dealerships. All these dealerships have done very well over the last few months, and we see that as pull ahead of a lot of sales. So we're going to see a downturn in the second half. That's also going to coincide with higher prices because of the additional cost of shipping key models from South Korea and models from Canada and Mexico, as well as the European imports. All the parts and all the vehicles are costing more, so those prices are going to have to be reflected in the new price of vehicles, and it's going to slow sales going forward until the consumer gets used to the new normal.
Absolutely. So, potentially big impact, big waves coming for the vehicle logistics networks there. Peter, great to have you back with us. Just as we about to close and finish up, but I thought I'd get your perspective on a couple of these topics as well, in terms of some of the direct measures Volkswagen have taken to respond to the ongoing US tariff and trade changes, and how have you managed these kind of in the short term?
Yeah. Well, at the moment, there is so much uncertainty. So we are really watching it more or less on a day-by-day basis. What's the trends? What's the news? We did not really see drastic reductions in volumes going towards the US, but that's probably the same effect as Sam was just reflecting on, because prices have not passed through and a lot of consumers were pulling cars from the dealers these days. But we have done some adjustments on our fleet of chartered Ro-Ro vessels in order to be able to react and to be prepared for less volume, so we do not sit with excess space there in capacity, which we will not need in the future.
Yeah, excellent. And then perhaps one final question as we're getting pretty close to the end of our hour here, Peter, for you and your perspective. What have been some of the major lessons learned from this year, from the ongoing challenges that we face and discussed at length here, and how will they shape VW's future vehicle logistics strategies and network designs?
Yeah. So what was really a key learning is, but I think it's not only this year, but that learning started a couple of years ago already. Once you have a setup, you cannot take it for granted that it will be in a stable mode with predictable volumes, with predictable market demands. So I think when you create a structure, create a network, you have to build in a lot more flexibility and the need to react and adapt to changing circumstances. So these changes in flexibility upwards, but also downwards, we are basically reflecting in the concepts. We are also discussing with our partners and building in the contracts. And for sure, you also need backup solutions. So if one element of the network or one element struggles, you need to be able to move either from rail to road or from road to rail to switch from one port to the other. And these things need to be considered. And the Port of Venice, what we discussed, is a prime example to build in so-called resilience. If we have a struggle in the northern port, we can also allocate other volumes to the south or vice versa. And for sure, also big lessons learned is that you need to exchange information in a quite frequent, in a transparent way with all of the partners within the automotive supply chain. And we have also created a tool, our so-called outbound order book, which really helps us to communicate using communication standards, sharing information quite transparently and frequently. And we are also having high frequent meetings with our key service providers and strategic partners to really reflect what's the tendency, what's the developments we see, and how can we adapt to it.
Yeah, excellent. Well, thank you so much there. It's been a fascinating hour and a real pleasure to spend time with you all and my colleague Emily as well. So a big thank you to you for your insights. What's clear is that there's more twists and turns to come for the FEL sector. But what's clear from Peter's messaging as well is that there is proactive measures that can be taken. We can shift from reactive to proactive in order to take control, still optimize, work towards car maker goals of reducing emissions, controlling costs, and improving efficiency despite these uncertainties and challenges. So that's it for today's show. So again, a big thank you to my guests. We'll, of course, be delving deeper into these topics and more around the world at our various different events. So I do encourage you to come, connect with your peers, benchmark from one another, hear keynote speakers and presentations, panel discussions like Peter, like Sam, who will be involved in future activities. Not least our 25th anniversary global event in Detroit coming up in September, our Europe event in Bonn next March, and finished vehicle logistics in California, as I mentioned, and a host of others. If not for the benchmarking, the insights, come for the group therapy at the very least. So do stay tuned for our next live stream as well. We'll be bringing you insight and intel, our next one in October on automotive packaging, and then looking ahead to December, we'll be also focusing on that 2025 review and what 2026 holds in store. So that's it for today. Thank you all to my guests. Thank you for watching, and thank you to my colleagues as well for making this happen too. Thanks again, and see you very soon. Bye-bye.